All right, listen up. OG John AG here. This is not casual price action. This is structure under pressure. Silver just blasted above 91. First notice day is 2 days out, 2 days. Shorts feel that clock ticking. Registered silver sitting at 87.2 million ounces. Open interest heading into settlement 115 million ounces. Do the math. That gap is not noise. That is structure. If you consider me your bro, your buddy, then make sure to like, subscribe, and drop a comment telling me what you want to ask about this. Yesterday alone, 71 million ounces got rolled. Largest single-day roll we've seen, and price didn't drop during that roll. It pushed higher. That matters. When size rolls and price rises, that tells you demand is absorbing supply at those levels. That's not weakness. That's positioning stress showing up in real time. Let's frame this clean. Western spot silver 90, futures 90, Shanghai spot 100, Shanghai futures 104. That is a $10 premium sitting in Asia versus Western paper pricing. $10. That spread has not closed, it widened. When physical in one region trades materially above paper pricing elsewhere, that's not a headline. It's a mechanism. It's a signal that physical demand in Asia is bidding above Western derivative structure. Arbitrage desks see it, vault operators see it, shorts see it. Now step into the settlement mechanics. First notice day in 48 hours. Registered inventory, 87.2 million ounces. Total open interest, 115 million ounces. Yes, not every contract stands for delivery. Yes, rolls happen. We saw 71 million ounces roll yesterday. That removed immediate force majeure chatter. Expectations of a March force majeure are now off the table. The roll worked. But here's the detail most people skip. Physical silver inside Comex vaults is not evenly distributed. Some bars are tightly held, some are pledged, some are simply not practically available for every short. So even if aggregate open interest drops below registered, that does not guarantee every short is comfortable. Distribution matters. Ownership concentration matters. Delivery logistics matter. And here's another data point that shifts the tone. Tuesday, another 1 million ounces left registered stocks. Gone. Now we're sitting at roughly 87 million ounces available against 115 million ounces of open interest coming into settlement week. You see the pressure? It's not explosive. It's mechanical. It's slow tightening. And the key metric to watch going into later 2026 isn't hype. It's simple. How much silver is backing the futures market? That number keeps drifting lower. As long as backing declines while price holds structure, that imbalance builds. Price reflects what is known. Risk reflects what is building. Let's talk spreads. The sequence in tight commodity markets usually unfolds like this. First, the front spread flips. March, May, or later, May-July moves from contango into backwardation. When that flip happens, you start seeing outflows accelerate from Comex. Metal moves where the premium is. If Shanghai keeps paying up, bars migrate. Then retail notices the move wasn't just a spike. ETF flows begin. That pulls additional physical off the market. That's how tightening compounds. It's not dramatic at first, it's incremental, then it's visible. Now zoom over to Shanghai, spot 100, futures 104. That $10 premium relative to Western 90 pricing hasn't resolved. SHF silver inventory plus 5.95 tons. Yet at the same time, SHF suspended 25 trading groups in February for breaching Article 16, exceeding daily opening limits, violating exchange trading rules. Translation in plain language, size got aggressive, positioning got concentrated, exchange stepped in. Exchanges don't suspend 25 groups in 1 month during calm conditions. They act when volatility, concentration, liquidity imbalance, or delivery risk starts flashing yellow. That is not random enforcement. That is risk management under stress. Now layer psychology on top of mechanics. Daniel Kahneman talked about System 1 versus System 2 thinking. Under stress, market participants default to fast emotional responses. Shorts right now are staring at 48 hours to settlement, a persistent $10 Shanghai premium, 25 SHF suspensions, and tightening registered stocks. That cocktail triggers System 1 reactions. When covering becomes emotional instead of strategic, price can gap in discontinuous fashion. Volatility indices start pricing that possibility before headlines explain it. The market has not processed this yet. GSR, gold-silver ratio sitting at 57. It just broke back below its 50 DMA. When GSR compresses from above 60 down toward 50 and slices below moving average support, that signals a relative demand shift. Silver is no longer behaving like a chronic laggard. It just touched 91.14. The 50-day moving average sits at 81. Since May 30th, that 50 MA has not declined. Rising moving average. Price holding above it. That is classic trending structure. Not a bounce, not a dead cat, structure. Let's go back to the chart levels because structure is everything. Resistance was clearly identified between 87.20 and 89. Price broke through with an hourly close above that band. Ran to 91, pulled back to 90. Former resistance now acting as support. That's how healthy breakouts behave. If you were watching those levels before the move, you understand what just happened. If you're learning how price respects pre-identified zones, this is textbook behavior. Reading structure in real time, not drawing lines after the fact. That's the difference. Now, supply side, Mexico, largest silver producer globally. For the first time in history, silver declared a critical mineral. AI applications, defense systems, solar, industrial demand. Roughly 50% of U.S. silver imports come from Mexico. The U.S. has modeled scenarios where supply disruption from Mexico impacts GDP and raises national security concerns. Recently, 10 workers from a mining company abducted, 3 found dead, security costs rising, recruitment getting harder, transport disruptions increasing, cartel violence escalating in northern regions. This is not a doomsday narrative. It's risk layering on top of an already tight market that has run 5 consecutive years of deficit. Comex inventories have been steadily draining during those deficit years. World demand continues, largest supplier facing operational friction. That is a structural variable, not a headline spike. Coordination between the Trump administration and Mexican government appears aimed at restoring federal authority in cartel-dominated areas. Early signals suggest stabilization efforts underway. Markets will watch that closely. Because if transport normalizes and security costs ease, supply risk premium could cool. If not, that premium builds quietly and forward spreads. Let's not ignore the other side. The 71 million ounce roll yesterday worked. Force majeure fears did not materialize. March settlement could complete without major incident if remaining positions continue rolling or accept cash settlement. Shanghai premium could narrow if Chinese demand moderates or Western supply increases. SHF enforcement could stabilize positioning and reduce volatility. Markets are dynamic. Both pressure and release valves exist. But here's what stands out. Price moved higher during the largest roll we've seen. That suggests underlying demand absorption. Registered inventory continues to trend lower. Open interest still above available registered metal. Shanghai premium persistent at $10. GSR breaking down. Technical structure holding above former resistance. Supply risk from Mexico layered into a 5-year deficit backdrop. Exchanges in Asia stepping in to control aggressive positioning. That combination is not random. It is interconnected. Shorts right now are not in panic mode publicly, but nervous energy is visible. Crowd psychology shifts fast when participants realize positioning is wrong. Gustave Le Bon wrote about how individuals become a crowd under stress. Rational decision-making yields to herd behavior. When exchanges intervene, it confirms positioning concentration was real. That is not rumor. That is documented enforcement. Verify SHF notices yourself. Verify CME data yourself. This is about observation, not belief. Price reflects what is known. Risk reflects what is building. Over the next 48 hours, here's the clean watch list. Monitor Comex registered stocks for any additional outflows. Watch total open interest decline or persistence into first notice. Track March-May spread behavior for any flip toward backwardation. Keep eyes on Shanghai premium. Does that $10 compress or expand? Check SHF enforcement updates for additional suspensions. Observe GSR behavior around 57 and its 50 DMA relationship. Watch whether silver holds above that 87-20-89 former resistance zone now acting as support. Track any Mexico security updates impacting transport or production. No predictions, no hype, just structure, spreads, positioning, and behavior. The ones who monitor those inputs in real time understand what's forming before the crowd does. This is not a headline, it is a mechanism. Stay sharp. OG John AG out.